Good morning, Trinidad and Tobago, and welcome to the Bourse Report. Well, today we're continuing to shed some light on financial results so that investors can make more informed decisions. And today we're taking a look at Scotiabank Trinidad and Tobago for its half-year ended, April, as well as GMMB for its full fiscal year ended March 2021. Both companies would have reported improved overall profits, but however, GMMB would have recorded reduced earnings per share. Let's take a look at why that would have taken place and help investors make a better informed decision on their next steps with regard to Scotia and GMMB. Turning quickly to Scotiabank Trinidad and Tobago, it's SBTT. The group would have recorded an earnings per share figure of $1.73, which was a very impressive 15.9% increase from that $1.49 recorded in the prior comparable period. That was a pretty good bright spot. However, overall total revenues did decline just around 5% from 915 odd million to just around 868 million TT. We had non-interest expenses declining just around 7.3% on a positive note from 403 to 374 odd million. There was a very sharp decline in net impairment losses on financial assets from 119 million in the prior comparable period to 34.5 million, and overall profits available to shareholders would have increased from 262 to just around 304.6 million. So pretty good news on the profit front, but most of it would have been driven by that decrease in net impairment losses on financial assets. When we take a look at the revenue story, there is a little bit of a concerning trend where we see that this has been the second consecutive quarter or comparable period rather of declining revenues in the half year of 2020. Total revenues declined just around 0.5%, so a fairly marginal decrease. That has accelerated into the half year or 36 months of fiscal 2021 for Scotia with that 5.1% decrease. We can see net interest income falling from that 664 to 621 million, and other income falling from 251 to just around 248 million, roughly a 1% decline in other income. Now, the good news for Scotia investors or Scotia shareholders is that that dividend that they would have paid has been boosted for that the half-year period. It would have been boosted from $1 historically to $1.20. Whether that's going to be a continuing trend or if it's maybe making up for lost time in the past fiscal year where dividends were a little bit shakier, investors will have to wait and see. However, it means that Scotia would have boosted their dividend payout ratio from around 50% over the past each half year 2017 to 2019 up to around the 70% level, meaning that for every dollar of profits generated, they are paying out roughly just under 70 cents, at least for this most recently concluded period. So at a price of $57, Scotia is trading at a price earnings ratio of 17.9 times, which compares relatively favorably to the industry average or a sector average of 22.6 times. Take that with a pinch of salt. Most companies are trading at elevated valuations relative to historical levels. Scotia does offer investors a dividend yield of 4.3%, which compares quite favorably to the sector average of 2.2%. So on the basis of fair valuations, those consistent dividend payments, but again with that lingering economic uncertainty, particularly pervading the Trinidad and Tobago in economic environment, Bourse is going to maintain a neutral rating on Scotia for the time being. Turning quickly to JMMB Group Limited, well, the group recorded an earnings per share decline of just around 4% from 18 cents TT dollars equivalent to just around 17.3 cents per share. Now, on the bright side, operating revenues did increase from 970 million TT equivalent to just over the $1 billion mark. Operating expenses also decreased. So two very good trends there in terms of operating expenses and operating revenue. That there was a decline in those operating expenses of about 9% to 655 million TT equivalent. However, the increased number of outstanding shares would have weighed on that earnings per share figure and diluted earnings per share despite an overall 7.3% increase in profits available to shareholders from that 315 to 338 million TT dollar equivalent. When we take a quick look at the operating revenues by component, there was some mixed results. Net interest income would have increased from 419 to 472 million in that yellow segment there. Fees and commissions would have declined from 95 to 78 million. And forex margins from cambio trading would have also declined from 127 million to 87 million TT equivalent. There were increases across all other operating segments. So certainly a positive trend on the revenue side, but that share dilution again would have watered down earnings per share to some extent for investors. So at a price of $1.76 per share, GMMBGL or GMMB Group is trading at a price earnings ratio of 10.2 times, which is pretty much in line with the sector average of 10.8 times. The dividend yield, however, is something that investors may be focusing on at 0.6% compared to the 1% average for the sector on average. And so on the basis of fair valuations, financial market stabilization, which will always be good for the investment portfolio of a company like JMMB Group Limited. But again, with that regional sluggish economic recovery in mind, Bourse is going to maintain a neutral rating on GMMB for the time being. Well, that's it for this week's edition. For more information, you can give us a call at 226-8773, email us at invest@boursefinancial.com, or check out our brand new website at www.bourseinvestment.com. And of course, you can catch us in the business section of today's edition of the Bigger, Better Trinidad and Tobago Guardian. See you next week. This has been the Bourse Report.